Is it visible?
Yeah, can.
Okay. So for today, I'll be presenting Target, ticker in New York Stock Exchange as NYSE. Current price of 216 and 64 cents. I'll go through the summary and overview. Target is founded on 1902, IPO in 1967. It operates as a general merchandise retailer in the United States and is the 8th largest retailer by revenue size, not by market cap, and currently it has 100 billion around 100 billion market cap. Recent years, especially during COVID, it has some great top line growth and one of the highest gross profit margin compared to the other retailers, and it has a strong operating cash flow recently also, because due to the COVID pandemic, when you think retailers are doing badly, well, it did for like one quarter ish, but after that everything with the stimulus check and stuff, yeah, later I'll go on. And yeah, key findings that is currently right now undergoing a remodeling phase, and I found out that to put it in a nicer term, it has only normal competitive advantages, not much. I don't really find much competitive, at least in the mode sense. It has some competitive advantage that differentiates them, but not much of a mode, and there's not much insiders ownership. So I'll go through the management. This is the CEO. He is CEO since 2014 until now, and that was the period when Target actually undergo an e-commerce phase, and right now I think the stock price has at least 3 to 4x when he took over. So that's his, and he's still currently the CEO, so I think that's a good thing. And previously, before he became the CEO for Target, he was a C-suite like chief of marketing or even CEO for Sam's Club and PepsiCo and other brands. So he has the leadership background lah. This is the chief store officer, so he basically oversees the operations of the store specifically, and the merchandising, and also the what's the thing called, layout in a sense also a bit. And he was in Target since 1999, so it has been almost 20 plus years in Target, and he climbed up all the way through. He went through like several other departments, from merchandising to sourcing to operations, and also uh, creating experience specifically for urban areas only. So yeah, I guess he has the expertise on it also, and he's been here for 20 plus years and grew the company a lot. This is the CEO, so he does the he does this merchandising also, but he mainly does on the supply chain, because when supply chain is actually quite important. Later I'll go into Target's business model specifically, and how they're changing their business model a little bit and tweaking it. And yeah, previously he started off as a accountant financial analyst guy in Target in 1996, so he transferred also several positions, and finally in 2015 he became the COO, and until now. So that's also when like the transitioning to a little bit of e-commerce and stuff also. So yeah, he also grew 4x with the company. This is a chief information officer, which is also another key part on the on how when the new retail generation's coming lah, and he will be a key important to it. So before joining Target in 2015, he spent 17 years at Tesco, and also as a IT guy lah, and he does like the technology roadmap and data analytics, which is the most important part for retail, because they gather data and stuff and understand the behavioral concept of their own customers. I'll go to the next slide. Okay, the business model. The retail business model is, this is the simplified version, but later I'll go into specifically for Target and how the supply chain actually works. So this is right now the current. I'm pretty sure all of us know how retail works. Maybe a wholesaler, then they sell to retailers, and retailer have a little bit of higher margin because they also take on some risk like distribution risk and material pricing and local competition and stuff. That's why they but they get higher margins in a sense because they have more risk exposure, and they just pass it on to consumers, and they are the B2C in a sense, because wholesalers are B2B and retailers are finally the one that pass it on to consumers. So I go to products. So they have three different kinds of target stores. The first one I'll go through is the super target, where it's the largest one and average around 175,000 square feet. This store basically covers everything, and usually, okay, another key thing, I'll go into the key partnerships, but a lot of these stores, they're basically one-stop shop lah, and these are like shopping malls already for us Malaysians. It's basically like you can say it's the Sunway, or I wouldn't say Sunway because it's a theme park, but more like a Mid Valley and stuff like that lah. So they basically cover everything, and yeah, from food and beverages to your electronics and stuff, and toys also, beauty products also. So this is their second product, which is the normal one, just the normal target. It is 130,000 square feet. This is like the normal. It doesn't have the more optionality compared to the super target, because super target is basically an oversized target. That's how they summarize it, with just more stuff. But yeah, this is the normal target. And the recent one that they really want to focus on is the small front, which is like a small, you could say it's a not really small, but a decent boutique firm, a boutique boutique store for like affluent places. They put it in more urban areas, and it has more personalized products. So let's say you put it at college campuses nearby there, they perhaps the clothing choices, because it's only 30,000 square feet, so they will put in more personalized products over there. And yeah, this makes it more efficient, because they also, after doing this for I think few years, they found out that there's 3 times more sales per square feet in this small front stores compared to the normal target stores, because yeah, they are more personalized in a sense, and that's why I say data is very important, and later I'll get into how they collect data. So their own portfolio of brands, this is they are basically 45 private brand labels, and they are exclusive to them only, where they some of the half of the 45 is their own, they came out themselves. The other 45, the other 20 plus is they sign up sort of a partnership and go exclusive with them. So we have things from like Ben and Jerry's, and that's the ice cream one, and also the Cascadian Farm for organic foods and stuff. And they have another thing to think of is their loyalty program. So once you get you can get a card, which is either a credit or a debit card. You get free shipping, and also have extra 30 days plus for returns. You already have 90 days, then you plus another 30 days, so if you're not that satisfied after 4 months, you can return back, and you have around 5% savings. And this new thing that they added, the Circle app, this is a downloadable app. When you download it, you can earn 1% as points, and later you can redeem it as vouchers and stuff, and you get deals, and you have birthday gifts and stuff. And a portion of the sales, or I think it's 1 or 5%, I've forgotten, but a portion of all the sales will go to like your community. You're basically somewhat, where every time you purchase something, you're donating to the poorer community, or helping different colors, ethnicity, and minorities lah. So, and this is also another data I found out, is that they released this Circle app is to sort of attract the non people that don't have the card or too lazy to sign up. So they use this app because it's much more easier to download the app rather than signing up for a card. So if people are lazy to sign up for a card, they download this app, and this is to encourage them to spend more. Okay, this is the key partnership and the target effect, which I found out, and it's experience centric. So you look at Target, they are very red and trendy in the sense it's very bright, and this visual atmosphere sort of encourage shoppers to spend more, and with their good layout formation. So what they usually do, because they partner with two of the most I think the key partnerships are Starbucks and CVS. However, recently they partnered with Disney and they have their own merchandise section already. But in my opinion, Starbucks is one of the most important, because every time when you enter Target store, you have inviting atmosphere and the sense and the smell of Starbucks. So it forces you, and you know how Americans, they enjoy their coffee in Starbucks. So once you buy a coffee, what are you gonna do when you're in such a big and nice bright mall? Of course, you're gonna browse around the store and not just come for coffee, right? Because once you got coffee, you gotta walk around and stuff, and you're gonna be with all the. I've read a psychological study also, where with all these nice colors, and if it looks very uniform and follow the theme, you're prone to buying more stuff. And CVS, where the CVS pharmacy, which I covered last week, is perfect for Target, because they are also red color, and they partnered together to make themselves the one-stop shop. Because before that, Target doesn't really have a strong pharmaceutical portfolio. Hence, once they partner with CVS, they have a healthcare section already. And sometimes, if, as you know from CVS pharmacy, from my previous what's the thing called, sharing presentation, they have their own minute clinic. So imagine your Target also have a clinic. So yeah, you can go there and check out in a sense also. So they really become the one-stop shop with like attracting people, and it's very hard for just shoppers to just buy one item. And remodeling stores, this is what they are going through since 2019. They are renewing aesthetics, as their consumers are newer generations, and they're adding more growth to it. So you can see before and after. The guest service before looks more dull, and after remodeling, they are newer and more slicker compared to the arrangement of fruits and stuff. Also, the groceries. Not just that, even your home cookware, and also the beauty products. So another thing to take note of is that you can see this very good spacing between the for shoppers to go around. So they really emphasize on like the experience and stuff lah. And also a newer brand and look for more aesthetic purposes for younger generations. So another thing why they remodel their stores is to leverage them as e-commerce hubs for better margins in a sense. So traditionally, how the supply flow work is basically your order, then they'll deliver to through distribution like FedEx or UPS or stuff like that. Then once after you remodel, right now you have your go to store and collect, where you can just order the thing from the Circle app. Then you can just go to your nearest Target store, and you don't need pay any third parties fees to deliver, and it's faster too, because the 2017 they acquired a company called Ship, this company, and they allow same day delivery. So you can just order, and you just can leave your parcel over there, and you just book a time, then you just go and collect it. Other than that, they also added up a pick and drive up function, where you go drive your car there, you can order while in the car, and the people will just put it in your car trunk. You also have your sort of a in-store customer to come in, and yeah, you don't need to use delivery free. So the distribution center and the ship will go to the Target store as a central flow, instead of going through like the FedEx and stuff, which would delay the delivery. And with Target store, you also have a more personalized experience where you can see the Target store people greeting and also handing you the parcel. So yeah, this also save them money. And there's also a statistic that came out since 2000, because this remodeling stores is quite new, 2019. So they sort of released some data. They haven't released their 2021 annual report, so you only have 2 years of data. So the first year after you remodel it, your store will improve 2 to 4% in the first year, and the second year is 2%. So I'm waiting for the 2021 and see how much it improved post-COVID and stuff. Because this pre-COVID 2019, 2 to 4% is quite impressive already, and then during COVID at time it also increased by 2% though, so not bad. Then your shipping, imagine from stores to yeah, you ship to your stores instead, is 40% cheaper than shipping to the using the third party distributions, third party, yeah, all those logistic companies. And if you click and collect, you don't ship from your store to the people, you get is 90% cheaper, because that's when customer come to you to pick it up. So yeah, if you use shipped, they acquire the company. If you ship from the store, it's 40%. But if the customer come to you, which a lot of time they would, is 90% cheaper. So you need spend what 10% compared to FedEx and stuff like that. And its omni-channel customers spend 4x the as much as store only customer. So omni-channel meaning that they have the drive up, order pick up, and ship, which is from their store for same day delivery. And in the next 5 years, they project that all the current stores of 1,900 stores would be all remodeled and new. So yeah, mainly the remodeling is for e-commerce hub and the aesthetic purposes. So we can see how the e-commerce hub really works. 95% of their sales comes from the stores, will be fulfilled by stores itself. So only 5% is fulfilled by other means. So everything is fulfilled by stores, majority at least. And also since their growth is quite impressive, around 45% on these three new the services, the same day services, meaning that you can just order from your app. You either drive to pick it up, or you go there, park and pick up and walk around, or you ship same day delivery. 45% grew year on year. And the most growth come from drive up, where people just go there, drive up, and just order themselves, which means you save a lot of cost. And for 2022, they are adding Starbucks and other products, but mainly Starbucks where you can just go there and just order Starbucks and your other products together. So the same store growth, so you can see the trend over here. In 2021, the result came out, it's only 12.7% compared to 19.3%. Because COVID at time, I assume there's a lot of pent up, and like third quarter, fourth quarter really boosted them up. And yeah, they really spent a lot, especially on durable goods and stuff. Let's say your camera for a meeting, your electronics, your earphone or whatever lah. And you get steamy checks, so yeah, that's why it also really helped out with the quarterly results. And if you compare quarter to quarter, fourth quarter of 2021 is 8.9% compared to last year 20.5%. So you can see that it's really going back down. However, since 2017, where they added the app and stuff, you can see that it started to pick up more and more. Also another thing is that later I'll go at additional info. It's not just that, they also have a tailwind that they might be able to capture in the future. So yeah, but I would say that in the future it normalize back to around 5% same store year on year growth on the conservative. If you're very optimistic, it'll stay around 8%, but I'll foresee 3 to 5% is more realistic. And revenue by segment, so they have a portfolio, it's quite diversified, so they don't really rely on one thing. You have essential and beauty, household furnishing, food beverages, electronic toys, and apparels. Other than that, digital sales accounted for more than 17% in 2020. They haven't released on 2021. I would assume that it's 20%. I would say around there at least should be. And yeah, for highlights, their revenue has grown since 2019, pre-COVID. So they have grown 35% since then. And most of the sales, this 27 billion of sales, actually half of it came from digital, and 14 billion came from the traditional way. So digital, it doesn't mean that it's not physical, but it means that you're using the app. And this shows that during this time they really collected a lot of data, and they will understand consumer behavior and stuff, and they offer coupon. And your traffic's up by 12.3%, and most of their core products, which I presented just now, have double-digit growth for all of them. So I think that's good. However, I'll foresee home and the hard lines to slow down a bit, because those are like the hard durable goods. I assume that only the apparel, food beverage, and essential beauty are the ones that are gonna continue growing more compared to the durable goods. And 30 billion is of growth is in of sales are in the brand sales, and that means their own brand. They release one, not the partners, but they release their own brand. And yeah, you can see that people are actually using target brands by 18%. So industry and positioning, They have a total go through the total addressable market for retail off and online. There's a data it released in 2021, and it expected a 7% CAGR rate from 2021 to 2025, and it will close to around 29 trillion, if not 29k billion, but it's 29 trillion you could say. For e-commerce retail, if you use your app and stuff like that, the CAGR rate will be better, and they split it out to a few sections, but food and beverage is more the most growth, followed by toys and stuff, and you could expect a 13.5% CAGR rate. And this is released in 2022 studies. So the future of retail, I would say that digital sales are of course the one, and how you can see Target is already positioning themselves by using the central flow model, and consumer behaviors are saying that they, of course, brick and mortar are still here and they'll stay because the experience that they want and the quality of customer services. So yeah, for like some goods, let's say electronics, I'm sure that you, or even apparels, you would rather go there and test out like whether it really fits you or not. If not, you regret it lah. Of course, you can order it online because Target have like a 4-month return policy if you're a member. If not, three months. So I guess that's that. But I would say that a lot of consumers don't want the hassle of returning and was that going there and buying a new one. So yeah, I assume that physical brick and mortar is here to stay, but the growth is of course not that attractive compared to the online sales. And these are the 3 key changes in the future of retail, where customers are being more informed. When the newer generations come out and stuff, you have a lot of information of products, and you can just straight away compare pricing with just a single Google search. So for customers that are more informed, they would want more efficient and more DIY shopping experience. That's why Target is building the app, and they can just do their own shopping and don't really want to rely on marketing and stuff. And the rise of the multi-channel, so like I said, there's more interaction with classic brick and mortar like pickup, online purchasing, and this is a chance to build brand loyalty by having a smooth experience and quick fulfillment. Which means that, let's say your Target, whatever, they put it in your truck and stuff, and you put it nicely, then you greet hi and goodbye. Maybe even your order and pick up, you go there and pick up your parcel or your order, and the people there are treating you nice, and yeah, that's the most important thing. And data science, with with all these apps and stuff, you can study more consumer behavior and create a more personal experience. Hence, this correlates with their small front stores, where they can really as I said, they are really targeting that one to open, and it's 3 times more efficient compared to the normal stores. And here's some study, 25% of respondents say that they would switch brands more often today than before, so you really need to capture the customer loyalty. And the trust from family is better than trust from the company or press release or advertising. So the consumers really trust the word of mouth compared to others, and really can tell this because a lot of slanders has been happening on corporations, and people are slightly losing trust to the corporations and their marketing ploys. So yeah, word of mouth is always the best. Let's compare to Walmart. I would say later I'll show like statistics on other competitors, but I would focus on Walmart first right now because I think that Walmart is the closest competitor based on the products they offer and internet consensus from Reddit, Investopedia, blogs, and YouTube, and etc. And they're both categorized as sort of discount stores. However, in a straight up just summarize, Walmart is basically sort of the reliable for best bargains and perk, and Target is more of a premium and upgraded shopping experience. Yeah, and they're more expensive. That's what they say from Reader Digest. Let's go some comparison with the buyer's profile. Who are their customers? Both majority are female shoppers. However, we can see that for Walmart, the shoppers are unemployed and homemakers and stuff. For Target, most of them are full-time employees or students. And this also shows like the quality of buyer's profile later. Most of the Walmart are urban, however, Target is 95% urban compared to Walmart only 76. So that's why the small front whatever is 3 times more efficient because when you're urban, more disposable income, and yeah, you can put things more closely packed together and stuff like that. And yeah, this one for the education wise, Walmart have sort of fewer schooling years compared to Target, and Target customers have sort of higher, more disposable income and they are more trendy also. It's the millennials and Gen Z compared to the Gen X in Walmart. So we can see some key differences already on the quality of consumers. Some layout wise, we can see even like the restructuring model and stuff. Target have a and wider aisles and for them to shop around with compared to Walmart where everything is just so packed up and doesn't have a really color theme. You can see some yellow, some green, and some red over here, but Target is really like bringing out like the A game over there, like the lighting and stuff. Another interesting thing to take note of is that Walmart user base on their application is actually quite sad compared to Target, where imagine you have I think 5 times as much stores. Yeah, should be around 3 to 4 or 5 times as much stores, but your your application is uh, half of what Target has. So yeah, that's very impressive on Target. And even though Target has lesser stores, but they dominate most of like the big states where yeah, like especially Texas itself, and a lot of it yeah but this is on clothing and but clothing is also very perishable, and apparently a lot of people like the Walmart discounted clothing, but they will still prefer Target as a more popular choices. So some key points that really break down simply. Location wise, they are generally close, and because of economies of scale when one open one place, then generally they already survey the area and they just open up together. And then price, later I'll show you, it's actually quite comparative comparing the prices. And Target is somewhat cheaper at the Bay Area for some reason. For services wise, they feel that Walmart is better, which quite surprised me also because Target really emphasizes on customer service and stuff. And they say that Walmart customers are somewhat nicer, so when you shop around, you have nicer people and stuff. However, they say that the lanes Walmart are not efficient and it's yeah very new with long queues and the aisles Target are nicer and more lighting, and cart wise, Target have better carts and yeah more slick, more smoother and better visuals and stuff like that. So you have more better shopping experience. This is a shocking thing that I really found. If you find against Walmart the prices, you can see that Target and Walmart is actually quite comparable with each other. And this is based on one store in San Francisco. However, yeah, you of course cannot take this as the thing, but different blocks have different price points. However, after going through like 5 blocks, a lot of it actually suggests that Target is sort of similar pricing to Walmart, which is quite surprising. I thought Walmart is like the best saving in a sense. And this, you haven't even included the 5% discount from your card and the 1% rebate. So yeah, if you compare by service wise, shipping, you have your if you have free 2-day shipping if you order $35 or more. But Walmart, if you have Walmart Plus, you get shipping free overall. But usually for Target, since you're already sort of in the higher income bracket, you would definitely order more. And you can see the curbside delivery and return policy. They really have like same day, but Walmart cannot do same day and they need next day. So less efficiency for Target because they acquire the ship delivery and also their central flow. That's why they're remodeling their retail stores for the same day. They really want to emphasize on same day. You can click and really go there and collect on the same day. And you get a return policy wise, you have 30 extra days with the membership compared to Walmart. And for loyalty program, it's free. It's free to download the Circle app. You just download and stuff, and yeah. However, Walmart you need to have $100 per year membership. But Walmart does have savings on fuel and I would say more coupon deals and stuff like that compared to Target, but I'd say Target is catching up already. So let's look at the competitors based on market cap. We can see that Target wise, it's actually the third in market cap. I compared this few only. I didn't really add in Amazon because a lot of the websites say add in Amazon, but I will stick to the hypermarkets and general merchandise sources because I feel like there's a more fair comparison. And with like the Costco and Walmart are the two biggest giants. Employee count wise, Target is like the third largest. Third largest. But yeah, let's go to the valuation. We can see PE wise, they're actually quite undervalued compared to their peers. You see Costco at 44, Walmart at 30, Dollar General at 21, Kroger at 26, and Dollar Tree at 26. So I'm quite surprised, and the price of sales, they are quite fairly valued compared to competitors. EV EBITDA also is in the more undervalued side. And then revenue growth, that's why I was wondering, okay, your price undervalued, maybe your growth prospects not that much. However, the growth prospect is actually on the higher side compared to everyone. It's like the second highest. Your revenue growth forward, not based on past performance, is also the second highest. Then your EBITDA growth year on year is actually the second highest also. With your forward EBITDA rate also the second highest, you could say. Costco and Dollar Tree, Costco of course the highest among all this, which understand why they are priced at 44 PE, but Target is like half of the PE of Costco, but Walmart is somehow pricing better than Target, which is quite surprising. And yeah, the EPS, diluted rate and stuff also, they are generally for EPS itself, forward rate, they are the highest, so I'm quite surprised. And profitability wise, they are actually the second or third highest, but Dollar Tree, okay, second highest I can say. Dollar General is number one. Costco you cannot be number one because of the volume game and stuff. And Walmart is only 25. So yeah, Target has the second highest on gross profit margin. If you compare like other margins, ROE I wouldn't say it's really fair but okay, sure, you can just add that in. But ROA itself is the highest, and yeah, you can see that they're really efficient. Even their EBIT margin also, and their net income margin is the second highest also. Your downline also quite pretty strong and your revenue per employee wise, although your revenue employee is pretty is only quite fair you can say at best, but your income per employee itself, your bottom line, is actually one of the most efficient compared to others, other than Costco. But other than that, you're the second most efficient. So for financial wise, over the years you can see that it's quite some steady growth and stuff. However, the COVID really helped them a lot, spike up 2020 and 2021, which got the fourth quarter got released. Yeah, it increased quite significantly because of the app and stuff, and stimulus and disposable income and stuff like that. Then the gross margin wise has been quite consistent over the years, but later I'll show you like the trend on the graph. Operating margin wise has been improving instead, so you can see that the shifting on the renovation the renovation is really improving the margins, and the net income wise has doubled since 2016. Now let's look at quarterly. Yeah, it's the same thing. Your gross profit margins around the same, and recently 26.6, but this is due to seasonality. Later I'll show you. But yeah, quarter on quarter basis, it's good they improve, and net income is also growing, so that's a good sign. And it peaked during the this quarter, the fourth quarter of the COVID year, which is due to the holiday and stuff, and the pent up thingies, and also disposable income and stuff. And yeah, that's why you peak. I assume that it won't go back to this level anytime soon, but it will definitely be better than pre-COVID levels. So let's look at the income statement quarterly trend. There's some seasonality involved at every fourth quarter. As retail stores, you have holiday season during the fourth quarter, and yeah, that's why during the fourth quarter your gross profit margin also tank because those are time where you give out a lot of discounts and stuff, and because you want to gather more what's that sales to you want to get the market share, because it's worth to tank your gross profit margin for this one quarter to get more profit during that quarter. You can see net income over the years generally increase, and yeah, your revenue also generally increase. So let's go on like the January since 2005. This yearly, not on quarter basis. You can see the gross profit margin has last time 15 years back it was 30 plus percent, and right now it's slowly going up down up down up down. It's consolidating. Oh, it really got lower, but it's not actually not low as much as I thought it would. Over the past 15 years, 17 years I could say, with like Amazon disruption and stuff like that, your GPM only decreased by 2%. 2% only. So I think that's a good sign lah, which means there's some sort of they're doing something right, either on the brand loyalty wise or their efficiency wise lah. On the balance sheet, we can see that since 2016, their cash actually grew year on year. I mean, it decreased over the years because of some renovation and stuff, but after the COVID, then they really stabilizing back into the good cash levels. Your receivable wise is increasing also, of course that makes sense. But another thing to take note of is that although you may think that inventory is increasing and they are not going as efficient, but I would say that inventory increase because they're going more on the e-commerce side, and if you're going on e-commerce, you need to hold more inventory because just in case there's any order, and then I would say I'll give them the leeway lah. And their PPE wise, they're expanding and stuff. Then let's look at the long-term debt. Over the years, they actually stay around a pretty good debt level. Even though their cash has increased, your long-term debt level has actually stagnated. So that's a good thing. However, they're actually leasing more places. So I would add that into this section as debt because leasing for retail, I would say is sort of a debt lah. So yeah, you can take note of that. But I would say it's quite a healthy level for their debt to cash ratio. Let's look at the cash flow. Over the years, it has increased, and especially during the COVID spike. But prior to that, yeah, it's really good. As even pre-COVID, it's already increasing due to the reformations and remodeling. And recently, if you didn't take into account like the cash inventories, it's actually more than previously. But just take that into account lah. And I think it's not really a bad thing lah, but it's a good sign that it's increasing. But cash and inventory should be understandable because of the e-commerce thingy. And yeah, capex wise, they're ramping up really, and they have some guidance data I'll show in additional info. Investing wise, they are really investing on capex. Let's look at the debt to issue wise. They are sort of having a refinance on their debt, like paying off debt and then issuing more debt, or maybe they are paying out of debt or whatever, or debt that's coming up soon. But I'll say they are maintaining a quite healthy level. And the repurchase of common stock, so yeah, it's good at the repurchasing even during the bad time, although it's not that much. But that's why this year they repurchased 7 billion, so that's crazy. They really repurchase a lot, and they saw a conviction, I would say. And yeah, that's a good thing on the repurchase. And dividend wise, they never failed paying dividends every year. So some extra info. So I can see some dividend play potentially over here. Why? It's because let's look at this. Dividend per share is around only say $2 per share, and then it's $3 per share now. Okay, let's look at the payout ratio. Last time it was 40%, but now it's only 22%. So potentially you could say that when the growth stabilizes and they're not really growing anymore, then most of their free cash flow is no longer expended on capex, and they will actually spend more on paying back dividends. So if you expect the payout ratio back to around 40% level, you can expect maybe six bucks, but with expansion, maybe hence even $7 you could even expect in the future. Let's look at the EBITDA wise. It's really growing every year, and these 2 years are due to the COVID and stuff, so it's not really fair. But I would say EBITDA will grow back at the very least of 5% CAGR on the conservative side. And the same store growth year on year, yeah, it peaked at 19.3, but right now it's going back down. I would say around uh, maybe next year 8%, or then after that 5%, and 3% a bad year. But I would say at a good side would be 5% ish. Valuations. Let's look at valuation from Finbox. This DCF EBITDA wise is undervalued, has quite some upside to it. EV EBITDA wise, also another thing, the comparison this time from Finbox is actually quite acceptable. So it's undervalued compared to its peers. Price to sales wise also undervalued compared to its peers. PE wise is really undervalued, and yeah, they really value it quite highly. So here's some valuation for myself. I used some guidance and some own personal assumptions, and based on how I understand the retail market in the future, and you can consider this you can really consider a dividend growth model or DCF if you want, but I'll stay simple and use the PE model, and using historical PE of 13, 14 and 15%, and discount rate of 10% because of opportunity cost of the S&P 500. Why would I buy a value company if I have better return in like S&P 500 at 10%? And this model doesn't include share repurchase or dividend model in this model, so those are additional plus points to consider lah. And we can see in historical level, I won't include 2019, but 2015, 2016, 2017 is actually around 13 to 14, and right now it's around 15. So here's what I found out. I'll give you a K. Okay, never mind. This I think I entered you know what? Forgive me. I think I entered a wrong KGA earnings for this one. I had to put 5% ish, but yeah, just ignore this one. So later I'll type it in the numbers again, but yeah, sorry. That's my bad. Technical wise, I'll go on a monthly chart. Is double top on a monthly here, and it really broke through, right, because of the sell off and stuff. And you can say, yeah, it's a sell off lah, where it's really overvalued during that time, and I expect Costco and Walmart and stuff to also follow suit, because retail 44 PE not really that cool lah in my opinion. And yeah, weekly wise it's consolidating here. It might consolidate or even hit like a bottom of the price range over here, $170 over here. Daily wise, it's quite it's consolidating, and right now it's at 200 as EMA, which is very strong with the resistance level over here. So I would say high chance of consolidating and going downwards than going upwards. And competitors since COVID, let's see how they perform against their peers. The share price actually doubled since COVID and is better than their peers, which is good in a sense. Yeah, the market priced it quite well, but right now others are somehow catching up. Also not sure why, because I'll say Target is more undervalued based on the numbers and qualitative side. Shareholders Info, nothing much. I didn't really see any hedge funds or anyone that I really know, so just hedge funds, no Berkshire or Renaissance or Pershing or anything. So this is the sad part that I really don't like, where they have little to no insider, and yeah, no individual or insider holdings, and it's quite sad lah. And in additional info, macro factors, of course the rate hike and stuff will affect the retail, because inflation affects how we spend our money and stuff. Streets targets wise, they're really aiming for 270 level, so they're quite bullish still. Glassdoor, I would say it's a decent company overall. It's not really that bad, but all the complaints are just long hours, and it also depends branches to branches. However, the pros also say flexible hours and good environment and stuff, so it's really split up. But a lot of them approve the CEO and they recommend a friend to join this firm. This is the guidance where they say that they'll grow 8% first, and then after that it'll go to low single digit for the future, but for 2022 it will expect 8%. And for long term wise, is around mid single digits, and operating income also, and if adjusted EPS, high single digit growth. That's why the later I'll type in the technical model and just my PE model and just copy paste it again, but I'm pretty sure it's undervalued, and I sort of a rough estimate of where to buy. Capex wise, they are planning to spend 4 to 5 billion next year, because they really want to reshape the businesses and stuff and also expand. So other than remodeling, they will expand, because 2020 they didn't really expand that much, and 2021 also they are quite careful, so they are quite certain that they want to expand lah and remodel at the same time. And ROIC also, it has already passed through as a 20 plus range, I think, for 2 years, and they will expect for the 2023 and beyond it will range around 20 to 30% ROIC, which is very good, and I'll say it's somewhat realistic lah. But they say it's high single earning or 8%, I'll just put it at 5% lah for them, for a more conservative estimate later. Tailwind, there's some tailwind I would say. They will be able to eat some market share from weaker retailers. So you can see that let's say 2017 to 2019 they really grow, there's some growth to it, and I'll say some of the growth is actually due to the closing out of Toys R Us, Sears and stuff, where they bankruptcy. And you know how economies of scale works, right? Where like all the retailers all clumped up together, and what happens if some of the retailers on the same area close down? More market share will be eaten up by Target instead, which means because shoppers will have lesser choices than when someone just throw in the Target and stuff lah. And location, stuff like that, geographical location, it was good where everything is clumped up, so people have more optionalities and competition and stuff. And but then after that, when some close down, then you eat up more of the leftover market share lor, from the same residential pool. For more disposable income and stimulus in the future, if there's any, I think Target has potential benefit. Headwind wise, I'd say competition from Amazon and other retailers, Walmart and Costco are really coming in, because Walmart also sort of changing they're also downloading apps and stuff. I think they're also considering having their their stores as an e-commerce hub also, copy them. And inflation will happen, but I believe that Target would be more resilient in a sense compared to Walmart or Costco, because their consumers are more affluent compared to other retailers, and hence I think this is sort of a lesser headwind. It is a headwind still, because people compare the prices and stuff, but their consumer base I think are pretty strong lah compared to other retailers. And also they treat their employees very well. They announced that I think last year they would pay all their college tuition fee and also textbook and course fee and education expenses. And also their minimum wage is already $24 compared to Walmart at $12 still, and what is that, Costco at $17, which they say Costco is very good, but Target is already $24, so they're really treating their employees really well. So conclusion wise, I'll say that this is a great business that adapts, and because the CEO previously 2014 until now, then the share already tripled or quadrupled in prices, and he really changed like that. 2017 he launched the app, and 2019 he started remodeling, and he really knows how to adapt to the future and using AI and stuff. Although there's not much skin in the game, which is very depressing. If the management holds some skin in the game, I think the stars will align in a sense. And arguably one of the most efficient retail stores out there. There's some tailwind to either market share, but the headwind can be mitigated by passing on the cost to others. Decent growth and long-term dividend, long-term play because of the payout ratio and stuff like that. Though not much of a moat. Why I say so is because the moat is not really there, because it's the most likely is just branding only, and you don't really have switching costs. No, not really. People can I'll say brand loyalty and stuff on, and that's it. That's me for Target.
Thank you, Jason. Because you
Alright, here's the correction for the valuation for the video. My previous presentation session. So I entered in a 5% CAGR rate, everything else the same. I have a fair price of at least $195. Look at the price levels to look out for once again. here are some support levels to look out for. And you can see market really rebounded over here because the probably the EMA, the 100 weekly EMA, and also the what's that called? Yeah, it's sort of a fair value in a sense, and probably investors want to buy. And yeah, I'll make sure to put out the bottom few levels. I'll not buy this level yet, cause based on my assumptions. So you want to get a margin of safety. It's a concept where you get to pay for a discount for what is it? The company or a business, so you can have better return, and in case you mess up. So Warren Buffett or something would prefer like 40 to 50 margin of safety, but for target, personally, that's why I say investing is an art. No, that's why they also say it's an art, not a science, because everything's so qualitative and it also depends on how you look at things. I'm willing to pay a lesser margin of safety. Perhaps you can dollar cost average from like these few levels, and based on the market sentiment, maybe you can add in like the retail consumption rate or stuff like that. You can factor in either since there are lesser stimulus, would there be consumption higher or lower, stuff like that, you know? And you can basically just find like the price level they are willing to swallow. Because if I don't know, the Fed interest rate and everything increase, and it's a lot of macro factors, but if you believe it's gonna consolidate for a while, perfect. That means you have a chance to buy up stock at a cheaper price and be patient. And every month just dollar cost average and stuff. This is not financial advice, as I said in the beginning of the video. Plus, if it already consolidates around the same level, you can consider it as value as appreciated at least 10% due to the discount given. Like if you understand math, you know what I mean, and may give you additional margin of safety needed. Additional questions for conviction. Go deep dive into like the other businesses like Walmart, Costco, Dollar General, Kroger, Dollar Tree, and find out like the differences between them. Like you know how Costco, as I said in my presentation earlier, like how the margin is lesser, but what makes it so unique? Like how are they bulk purchasing so much? Is it because of the membership model, optionality of the product? Like they're offering like lesser optionality for like the like say one peanut, like let's say Walmart may have like 5 peanut butter, and all these companies, they of course they do like bulk purchase from wholesalers. But what makes Costco so different? Is it I'm not American, so I assume that they are sacrificing optionality of product, which means they may have three peanut butter brands only, and maybe cheaper brands or whatever. But yeah, that's basically about it. Like you must understand why. And is target like the business model like better and can continue either market share, can target business model compete with others? And this is why I say it's once again it's an art not a science. Investing and find out why Walmart is doing better compared to others. Is it because consumers that want Costco, want they want a safe cost, you go to Costco, and if you go for quality, you go for Target. Why go to Walmart if it's like sort of neither? Like you must find out why, and you maybe perhaps you find out more metrics and compare like the revenue or income per square or per store, get more data to compare. I don't know what else you can add in, but this is something I just thought in my head. And you can see my shitty ass slide I just finished in like 1 minute. I'm not American, but you guys have the opportunity to understand why Walmart is not performing compared to Target. You can find the edge of Target, and also you can understand the business model better. And I wish I was in the US to understand this more. Therefore, this is why a lot of investors, like even Peter Lynch, the one that I really like, uh, they say retailers have an edge compared to Wall Street. Like Wall Street just talk, and probably some of them really go deep down. But how many are there? Like a lot of the analysts just sit in the office and just assume stuff. Like how about you guys go to like the stores and just check out yourself and see what's up. You know, like why do you think you like Target more, or why do you like Walmart more, and stuff like that. Yeah, that's it from me.